You know, when you think of the greatest investor of all time, one name probably pops into your head: Warren Buffett. But how did he actually do it? You'd think his strategy must be some super complex, guarded secret, right? Well, the crazy thing is, it's not. His entire legendary career really just boils down to a simple, actionable blueprint. And today, we're going to break that blueprint down into 7 core rules. All right, first things first, let's just talk about the numbers. This is Buffett's average annual return since 1965, 20%. And we're not talking about a good year or two here. We're talking year in, year out for over half a century. I mean, in the world of investing, that kind of consistency, it's practically unheard of. This is the stuff that legends are made of. So you see a number like that, and you have to ask, right? What's the secret sauce? What kind of insane, complex financial wizardry did he cook up in that office in Omaha that nobody else could figure out? Well, here's the kicker. There is no complex secret. His entire philosophy, the very engine that built his massive fortune, is really just a short list of simple, timeless rules. Rules that, seriously, anyone can understand and follow. So let's dive in and break them down.
Okay, so it all starts with the right mindset. Before you ever even think about looking at a stock chart or flashing ticker, Buffett says you have to learn to think like a farmer. And this is the absolute foundation, the bedrock of his entire approach.
And this quote right here, it's the heart and soul of that mindset. This isn't just some nice little piece of advice, it's a filter. It forces you to completely shift your thinking away from short-term gambling and towards long-term ownership. Put it this way. If you're not prepared both financially and psychologically to stick with an investment for the long haul, you shouldn't even be considering it. Buffett loves this farm analogy, and it's brilliant. Just think about it for a second. If you bought a farm, would you be getting a price quote on it every single day? Would you panic and sell the whole thing just because of one bad harvest? No way. You'd focus on its long-term output, its potential over decades. And that's exactly how you have to view a stock. You're buying a piece of a real business, not a lottery ticket. And if you want to see that farmer's mindset in action, here it is. Buffett bought into Coca-Cola way back in 1988 for $1.3 billion. Today, that same investment is worth almost $25 billion. And get this, the best part is, it now pays him over $700 million a year just in dividends. That is the absolutely staggering power of buying a great business and just letting time do the heavy lifting for you. This is probably Buffett's most famous quote of all time. Now, let's be real. Of course, he's lost money on investments before. This isn't a literal command. It's a principle. It's a philosophy about risk management. It's all about building a defensive foundation for your entire strategy. So, how do you actually never lose money? Well, you manage your mistakes. You make sure you buy businesses for less than they're truly worth. That way, if you do end up being wrong, like he was with Taiwan Semiconductor, the mistake doesn't cripple your portfolio because you built in a margin of safety. He sold that one quickly, and that minimized the damage. The crucial part is you have to know when to stop digging. Okay, so once you have the right mindset, you need the right tools. And that brings us to our second big section, know your price. This is all about the practical, nitty-gritty methods Buffett uses to figure out what a business is actually worth. And really, it all comes down to one core concept: intrinsic value. This just means you have to learn to ignore the daily stock price, ignore all the market hype and noise. Your only job is to try and figure out how much cash a business is going to generate for its owners over its entire lifetime. The only reason you ever buy a stock is if you believe that future pile of cash is worth more than the price you're paying today. That's it. And the Apple investment is a perfect case study. Back in 2016, Wall Street was pretty lukewarm on Apple, but Buffett looked past the noise and saw a cash-generating machine trading at a very reasonable price. He focused on its intrinsic value and he bought in. And well, that investment has since become one of the most profitable of all time. This is another absolute cornerstone of his philosophy, the circle of competence. See, Buffett is famous for saying no. He's not trying to be an expert on every single industry out there. He only wants to play in the games where he knows for sure that he has an edge. Let me ask you a question. A stock you own suddenly drops 30%. What do? Is it a disaster, or is it a golden opportunity to buy more at a discount? Your answer to that question reveals everything about whether you truly understand the business. See, you can only answer that question with real confidence if that business is smack dab inside your circle of competence. If you don't really understand it, you're not investing. You're just guessing. You're gambling. And as Buffett himself warns, if you wander outside your circle, it's only a matter of time before you get creamed. All right, so you've got the mindset and you've got the tools. But the final piece of the puzzle, and maybe the most difficult part of all, is temperament. That brings us to our third section, wait for the pitch. This is all about patience, psychology, and knowing when to act.
Now, this is a fascinating evolution in Buffett's thinking, and it's all thanks to his partner, Charlie Munger. Early on, Buffett was all about buying cheap, low-quality companies. He called them cigar butts. But Munger convinced him it's far, far better to buy a truly wonderful business at a fair price than a fair business at a wonderful price. That one mental shift is what led to game-changing investments like Apple. Here's another one of those classic Buffett mantras. He understands that markets are driven by human emotion, fear, and greed. Most people just get swept up in the herd mentality, right? They buy high when everyone's euphoric and they panic sell low. Buffett's genius is simply doing the exact opposite. And this timeline shows he actually does it. The 2008 financial crisis, the 2011 debt crisis, the 2020 pandemic crash, these were moments of maximum widespread panic. And that's precisely when he steps up and makes his biggest moves. He uses fear as his single greatest opportunity. But here's the catch. Those moments, the fat pitches as he calls them, they do not come around very often. You might only get a handful of them in your entire lifetime. This means the game is mostly about waiting. It's about being patient and having your cash ready for when the world finally goes on sale. And this is a crucial warning from the man himself. For all the talk of avoiding bad investments, Buffett says his costliest errors were the great companies he understood but simply failed to act on. He famously called it sucking his thumb. He estimates that one of those mistakes, not buying Fannie Mae, cost his shareholders billions. The price of inaction can be absolutely immense. So, we've laid out the entire blueprint, the mindset, the tools, and the temperament. But knowledge without action is pretty much useless. Which leads us to the final, all-important question, will you swing? What are you going to do with all this? Look, you don't have to become Warren Buffett overnight. You just have to start. Go pick up a classic investing book. Read one company's annual report from start to finish. Take that first small step and just invest some money. The key is to move from passively learning to actively participating. Because make no mistake, another crisis is coming. Another moment of maximum fear and therefore maximum opportunity will arrive. The blueprint is clear. So the only question that's left is this. When that next perfect pitch comes sailing right over the plate, will you be ready to swing?